We are finally witnessing what is damn near well-deserved, and you know it. Like, you knew this was coming at some point because, man, the endless rallying and profit-printing machine we've all been experiencing isn't always the funnest thing when you're continually cost averaging into stocks. You know, we've been buying tech companies. We're going to talk about my positions, what I think about this market moving forward, and so much more in between. But there is a lot of red in the mega tech companies. This is all ahead of basically the March meeting that's coming up that, you know, we're going to obviously be leaving interest rates unchanged. The same in the Canadian markets. I mean, it's widely expected that they don't want to pull Volcker the market. There's no reason to cut interest rates when the job market is strong. I don't know why everyone was just kind of like preemptively thinking they were going to cut rates in April. We knew it'd probably be in the latter half of the year, maybe summer, fall. I mean, there's no rush on any of this, and it's going to leave a broader opportunity to continue to buy stocks that are suppressed if you were looking to buy real estate. Obviously, I think in a time where people are more suppressed, if you've got cash, it's probably the best time to buy real estate still, and these opportunities are going to leave. Because trust me, when they cut interest rates, there's going to be a lot more people getting mortgage approvals and are going to be competing and probably driving real estate values up. A lot of companies that are, you know, leveraged with debt and infrastructure, and companies like Tesla and Apple, they're probably going to start seeing a bump as people can start affording these higher end products again, right? And this is all during the same damn time that, you know, these social media websites went down today, which is shocking because it doesn't happen very often. And I know it goes beyond just Facebook and Instagram. There was a widespread outages, I think, with parts of YouTube in certain places. I don't know if it's cloud computing based or what the issue was. It didn't last very long. I mean, my Facebook, I went on, it doesn't working. Not even an hour later, it was all back up and running. And this is coming at a time when the S&P right now is trading at a multiple we haven't seen in a while. Considering the interest rate environment, we know it's primarily large-based tech companies weighting the S&P top 10, really driving a lot of these higher values. When Nvidia is trading at like a 70 or whatever the multiple is on it, Microsoft at over 30, I think it's closer to a 40 to be honest. It's no surprise that these multiples are getting much, much higher, and we probably need to come back down. Like, it was really nice when we were trading back down to the 20 to 25 range. I don't know if we're going to get that big of a correction in the market. We might. Time will only truly tell. Right now, I think what we're experiencing is a broad-based correction after a much-needed, you know, breath of fresh air with this crypto pump. And I think a lot of people that bought the tops are getting wrecked right now. I don't know if crypto recovers. It's the casino. Nobody really knows what's going on with crypto here after it corrected, after just touching all-time highs with things like Bitcoin. We saw Dogecoin. When memification starts coming back in these cryptos, you know that we're back into a clown market. And I don't know if that's going to persist or if it was just short-lived and we're going to go back to some nominalization and profit taking. Again, I just feel like we've been kind of getting in this really speculative phase of the market again for what doesn't seem to make a whole lot of sense. Whereas the other side of the market, the boring stocks, if you've had exposure to these, are actually offering quite a bit of cushion through this somewhat correction with tech companies because, you know, SCHD is relatively flat on the year, and it's not correcting to the downside nearly as heavily. I mean, you look at VDY on the Canadian side of the border is actually doing fairly well over the last 5 days. And sorry, we're just looking at the 5-day chart here. Year to date, I mean, again, mostly flat for that. Year to date on something like VDY, it's fairly flat. But for the yields that you're getting and the fact that it's kind of removing some of the volatility from your portfolio in comparable to the last 5 days where all the gains have been wiped out, the S&P's seen about 1.5 point correction here. But again, year to date, we're still up about 7 percentage points. We haven't seen any major correction yet in the broader S&P. The Q's dropping off a bit more, finally going red on the week, down about 2.7% from the highs. And the Q's really interest me because they've changed so much. I mean, you look at the top weighting of the Q's, and I'm kind of shocked to see that, like, they have Costco and Advanced Micro Devices outweighing things like Google. And I can tell that, you know, the Q's are primarily weighting companies that are chasing gains, I've come to realize, and that's not a bad strategy. Stocks that stay in motion tend to remain in motion. Companies like Microsoft, Nvidia, you know, Amazon's been coming back, Meta, but to kind of underweight some of these companies that, again, we can debate the value of them, things like Tesla and Alphabet. You know, I honestly think Alphabet should be more upper weighted at this point of the market cycle. But again, that might be because it's an 11th weighted position because you have Class A and Class B shares, so that might be something to take into consideration. I still like the Qs a lot. I think they could do some correction here when Apple, you know, that hasn't had any real revenue growth in quite some time, for the first time in a long time for that matter, is now down 8% on the year. This thing usually goes between 15 to 30% corrections fairly regularly throughout its history. Like, don't be surprised if this thing drops, you know, 20 or 30%. We're probably going to get some refresh on some products here pretty soon, but that's not enough to drive the stock. I think we're going to get another fascinating Q1 earnings come in the next month or two once we get through March, because let's be real, these companies haven't been able to get off the ground. Companies like Apple, Tesla, I'm really excited to see if it suppresses the stock further. Like, how long can people put up with, you know, depreciating revenue prices, even though they've been able to squeeze out a little bit better earnings? that can only last for so long in a declining revenue period. Costco's been jaw-dropping. I mean, Costco's been blowing up here. In the last year, it's up 57%, 16% year to date. Walmart following suit here, up 13%. Just jaw-dropping for these kind of traditional players. Things like Procter & Gamble doing very well year to date. It's nice having exposure to these kind of companies, you know, especially when things are taking off like they are. Companies like Pepsi, however, have been struggling catching steam, and I've seen the same thing with Nestle. Like, Nestle is a fascinatingly huge company that has exposure to a lot of different things like instant coffee, a lot of huge brands, and this thing is down dramatically. I mean, 20% over the last year, and I'm curious, it's wiped out 5 years worth of gains. This is a real intriguing stock to keep an eye on, something that I'm looking into a little bit right now. And the TSX, because it's more, you know, weighted toward some of these traditional infrastructure, traditional kind of stocks that are dividend focused, surprisingly doing really well in this kind of correction of tech companies, unless you're owning things like Constellation Softwares or Shopify that are getting absolutely kind of devastated here. I mean, how much has Shopify dropped for that matter? Let's just take a quick look here. Shopify stock down 3% just today alone, year to date wiping out just about 1% in gains. Like I said, we'll see how long this correction goes on for. I think we're going to get a bit of a breath for a little while. Like I said, we've gone on this wicked run that has led to way too high value. So what I'm going to do is wait a little bit. You know, I'm going to wait as we take a look at my portfolio just to stack some cash. I still got cash on the sidelines. I was like, I'm going to buy more Google here. I'm going to buy more Tesla. Like, my cost average on Tesla right now is at around 194. Google, you know, we're sitting at about 140. Really good prices. I need to see Tesla probably drop closer if we take a look to the 170s, like lower 170s, maybe 160s. I'll probably pick up a few more shares. I'd really like to see it. I'd go much more aggressive in the 150s if we can get down to those prices. What I'll do is probably hold off at least until Q1 earnings just to see how it pans out. And when it comes to Google, this thing needs to get into the probably 20s. If we get dipped down on the 120s, I'll probably be a bit more aggressive. But really what I'm doing is just seeing if the S&P can correct a bit heavier. Like, it'd be great to see probably about a 10% correction on VOO. That's what I'm kind of waiting for here before I become like hyper aggressive. As mentioned, I've been cost averaging all the way up. I just haven't been that aggressive. So if we can see like a really good solid, like we saw back here from that July to October timeframe, if spring comes around and we continue to see a bit more suppression and cooling off from this wicked rally and profit taking, like once we get into that 10% correction range, that's when I'll probably start offloading a lot more cash and being a bit more aggressive, but I have no reason to be here. In the meantime, I'm probably going to start taking a look again, as I mentioned, in some of the Canadian banks, things like VDY, as I've been meaning to get them back meaningfully in my portfolio. And that's where I'm probably going to keep eyeballing as these big tech companies start to correct, as I've got some pretty good starter positions with them. But time will only tell, right? Like, we never know where the market's going, and the only thing that I can suggest is just continually to keep buying. Like, don't change your cost averaging strategy by any metric. I just always recommend keeping cash on the sidelines like I do, about 10,000. I'll probably build this up a little bit higher here. And then once the market corrects by 10%, that's when I usually get really kind of giddy, as you saw last October. And that's when I'll do everything I can to offload like a lot more capital and start deploying a little heavier than I usually do. And that's worked out really well for the growth of my portfolio. But again, I don't know where the market's going. I'll pass the question off to you. I'd love to know what you think in that comment section below.